Hey everyone, welcome back to the channel, your number one source for income-oriented investing. Time to go over the high-yield income landscape on the US stock market. So let's first start with a overview of the market in the last month. It's been a pretty good month, and the last 30 days, if you will. And by the way, I'm filming this on June the 11th. So in the last month, the S&P up a little over 3%. The NASDAQ even better, NASDAQ 100 over 5%, really good. Bitcoin's up as well, 5%. Gold is up a little bit as well, 3%. So overall, it's been a pretty positive month for pretty much all asset classes, except for bonds, I guess, US bonds, but who invests in that anymore? I don't even know. I'd like to take a moment to thank the sponsor of today's video, FIRE ETFs. There are two of them, the FIRS or the FIRE Funds Wealth Builder ETF and FIRI, the FIRE Funds Income Target ETF. So just like the name says, these two ETFs were specifically designed to help support the FIRE community. So if you're in the FIRE community, you want to be part of that community, you're trying to reach financial independence and retire early, FIRS is really going to be the one where you're in the accumulation phase, you're wealth building. It's not designed for income. The FIRI one is designed to give you that income target of 4% annually. So both of them are really well diversified, and you could check them out, guys. You could just scroll down on both of them and see the holdings here, and they hold other ETFs, and combination you have diversification, especially the wealth builder one, because you're really going to be diversified for all sorts of market scenarios, including prosperity, recession, inflation, and deflation. And then once you hit financial independence, retire early, you could always go with the income target one, the FIRI, which targets, like it says here, a 4% target annual income level. So make sure to check them out. The link is in the video description below. Let's take a look, as we usually do, everyone, at the starting with the S&P 500 derivative or semi-quasi S&P 500 covered call ETFs on the American stock market. Starting with JEPI, of course, the most popular, and this one increased the distribution by quite a bit actually lately. You see here at 54 cents, the latest distribution. So right now the yield's at 11%, which is typically much higher than their typical 7 to 9% yield. You have Bally, of course, which I consider its biggest competitor. This one, the 12-month trailing yield is in the about 8 to 9% mark. Same management fee. Remember, these are stock picking within the S&P 500. You could say. Then there's YMAX, the yield max all in one, which of course is always going to have the highest yield, astronomical yield, weekly paying. And then you also have the S&P 500 equal weight advantage ETF, which of course I would never invest in. Equal weight, it's kind of like a DEI type ETF, right? Michael Saylor says it best. When you're doing an equal weight or you're diversifying, you're basically selling the winners for the losers, and that's what you're doing. I mean, everything actually has equal weight here. I would personally never invest in this one, but the yield's in the 9 here. So if we do a total return comparison, we have the 1 year. By the way, there's also Biggie. It's the yield max target 12. So I guess you could consider it, which has like 50 stocks, 50 important stocks, probably in the S&P 500. We don't have a year of data. But we do have year to date, and it's not going that well. The clear winner is still YMAX, everyone. Bally is outperforming JEPI still by a wide margin, but YMAX has been doing really well. And by the way, if you compare YMAX to VOO, the S&P 500, I don't know if you knew this, guys, but if you had YMAX on drip, you're actually beating the S&P 500. If you don't have it on drip, you are not. But still very solid performance by YMAX. That is definitely the one I would choose for an S&P 500 variance, if you will, or income ETF that I would hold in my personal portfolio if I was American. Moving on to the real and classic S&P 500, you have, of course, XYLD, which is a rinse and repeat strategy. You have GPIX, the one I like to consider like a default, what I always compare another S&P 500 cover call ETF to, GPIX and SPY-I. GPIX is typically 8% yield all the time. Very consistent monthly distributions, and SPY is around 12.5%. Then you also have the rinse and repeat IVVW as well, which is a 1% out of the money. Lowest fee, and the winner. The clear winner is still GPIX out of the bunch, but SPY, you can see here the 1 year is catching up. Sorry if it's too small, guys. Let me make this a little bit bigger. Of course, XYLD is going to be the lowest performer over time, I believe, because you're giving up all the upside. IVVW, not that great either, but you see here the common denominator, right? Actively managed, passively. The two actively managed strategies are doing really, really well in terms of your basic S&P 500 cover call ETF. So SPY, GPIX doing pretty good. SPY, especially lately, I think it's catching up here. So yeah, that's it for your classic S&P 500 cover call ETFs. Then of course you have the daily ones, which are going to cover SPY-T, XDTE, iSPY from ProShares, T-SPY, and you also have SDTY, which is very similar to XDTE from Roundhill. Total return wise by the daily or 0DTE S&P 500 cover call ETFs is relatively close, but we don't have a year yet of T-SPY. We're going to have that real soon. We don't have much data on SDTY as well, but XDTE doing really well still, but I believe T-SPY is still the number one out of all of them. If you actually do the comparison, XDTE versus T-SPY, T-SPY is on top. So T-SPY is number one, is the winner right now. Remember, the differences between them. SPY-T is at 20% annual target yield, paid out monthly. XDT varying, very high, but varying distributions, paid out weekly. iSPY is the one with the lowest fee, but it's, what's the point if you're not even going to outperform? Varying monthly distributions. T-SPY very consistent monthly, about 14%. SDTY very similar to XDTE. If you ask my opinion on which one is doing well, it's T-SPY and XDTE, T-SPY being the top one in terms of total return. Moving on to the NASDAQ 100 cover call ETFs, a very important index in the States. We're going to start with the classic ones. And of course, QYLD is the OG original classic one. Rinse and repeat strategy where you're giving up all the upside. The yield is always the same. It's always near the 12% mark. You do have JEPQ, which I decided to put in the classic, even though like JEPI, it's not exactly the NASDAQ 100, but it's very, very, very close. So close that I decided to put it in the classic, along with GPIC, of course, which is the NASDAQ equivalent of GPIX, which is typically 10% yield, paid out monthly. Of course, you have QQQI, which won Best New Active ETF. We'll see why in a second here. Last but certainly not least, well, actually it is the least, I would say, QQA, from the people who actually manage the QQQs or the Qs from Invesco. So it's QQA, and this is a classic strategy, a lot like GPIC, I believe, with an approximately always about a 10% yield. So what about JEPQ? They increased the distribution as well by a lot here. 54, 59, 62. So we'll see if that trend continues. It's very interesting because JEPI is usually 7 to 9% yield, and this one is typically 9 to 11. So JEPI and JEPQ very high. I guess maybe with the competition, they decided to raise their distributions. In terms of total return, it's not even close. The NEOS one, QQQI, maybe that's why it won its award, is outperforming everybody by a lot, except for GPIC. GPIC is doing really well as well. So I got to give my hat off to NEOS. Even SPY is starting to catch up. QQA, we don't have much data, but you could see here it's still behind GPIC and QQQI. So GPIC, QQQI, the two strongest right now in terms of your classic NASDAQ 100 cover call strategy. Moving on to the 0DTE, the daily option one. Of course, just like on the S&P side, you have QQQT from Defiance, which targets 20%, QDTE from Roundhill, IQQQ from ProShares, QDTY, which is going to be very similar to QDTE. So, and And I took out the QQQY, by the way. I'm not covering it anymore because it's really performing horribly, and you could actually see here. So I would not recommend QQQY being held by anyone anymore. Just look at the 1 year return, 1.96. That's terrible. If you look at QDTE at 12.88 in the last year, and so it's by far the winner here. So QDTE out of the 0 DTE or daily covered call, NASDAQ 100 covered call ETFs is still reigning supreme. And the Russell 2000 I won't be covering anymore because this is why. Look at the Russell 2000. There's some covered call ETF ones here, RDTE, etc., one from NEOS, one from Defiance, one from BlackRock as well. But I don't see why anyone would ever own this index. It's such a terrible performing index. And you could just see here by looking at the Vanguard Russell 2000 index, right? Russell 2000 versus the S&P 500. Look at the 1 year. Terrible, terrible performance. This is 3 year. This is 5 year. This is 10 years. So you can see how the Russell 2000 greatly underperforms the NASDAQ 100 and the S&P 500. So my opinion, there's no point, so I won't be covering the Russell 2000 ones anymore. And by the way, if you're American, I do have a very interesting video for you to watch. In case you missed it, it's called My Stock Portfolio If I Was American. So in this video, I go through my current Canadian portfolio and I basically tell you what I would own if I was American. I highly recommend you check it out, guys. Very easy to find. Just go on my channel and search for the title of the video. Moving on now to the, the other ones besides the S&P and the NASDAQ, you have GIAX, which is more of a global one. They do use 0 DT options, and the yield is very, very consistent near the 24% range. However, if you just do a total return comparison, it is not even close to beating any S&P 500 or NASDAQ 100 one. Same thing for SVOL. SVOL, although they re-increase the distribution rate, I believe, at 30 cents. It's not, it took a giant hit in April because of the big spike in volatility. Not doing well at all. I would probably stay away from these two if you ask me. Just look at SVOL versus XDTE, for example. You see this giant discrepancy in performance. Even if you do your classic SPY eye from NEOS, SVOL, you see there's a big discrepancy with the performance because of that April. Hopefully it's not too small for you, but when volatility spikes, obviously it was a big test for SVOL in April, and to me it did not pass the test. So SVOL I think was designed, if I remember correctly, talking to the guys, to give you S&P 500 type of return with lower volatility, and it's not really doing that. So I would think twice, especially if you own SVOL. I think you're just better off with an S&P 500 covered call ETF, and pretty much all of them are beating SVOL now. So moving on to a couple more alternatives. There's so many on the list now, everyone. You have Rex with the FEPI, AIPI, your classic tech, your AI tech. These are typically 24-25% yield for FEPI, about 34-35 for AIPI. They also have a crypto one as well. You have OMA from Vista Shares. There's so many more and more of these thematic covered call ETFs now. This obviously focuses, I did a video on this, but it focuses on Berkshire and the companies that Warren Buffett's company Berkshire invests in, with a 15% yield target. So I like that target. Nice. You have Maggie from, if you really like the Magnificent Seven, and in my opinion, they're probably stocks that are going to keep outperforming. You actually have a Magnificent Seven covered call ETF that Roundhill launched. Very, very interesting. So, and there's many more. They keep launching, right? Another very interesting thing that Rex Shares has launched is the growth and income ETFs. They launched the Nvidia one first. I made a video about it, but they're launching Tesla, or they've already launched a Tesla one, MicroStrategy, a Coinbase. So these are single stock covered call ETFs with 25% leverage. I repeat, with approximately 25% leverage, and covered calls on only 50% of the portfolio. So this is very, very similar to on the Canadian side what they do, which is more balanced in terms of growth and income, and that's why they have growth and income in the title. So these are extremely interesting Are these 25% leverage as well? I believe, yeah, between 105 and 150. So the average is about 125. So a nice little amount of leverage, not too much, right? Not like the crazy 2x daily. So a little bit of leverage and covered calls on only 50% of the portfolio. That's pretty much what Canadian funds do. And you guys know it's my favorite format because you have yield, high yield, but you also capture a lot of upside, and that leverage really helps. So hopefully Rex launches more. It seems like Rex was really the first one, first provider in the US that I've been begging everyone to do, come out with this format, 25, a little bit of leverage and the covered calls, and don't go crazy like the yield max and covering all the portfolio. So we'll have to follow. Maybe they'll come out with, an S&P one and NASDAQ one. We'll have to wait and see. Moving on to Bitcoin now, everyone. You have, of course, YBTC, BTCI, and there's more competition. These all, pretty much have very high yields. YBTC has weekly distributions. They vary greatly. BTCI, of course, you got to expect varying distributions as well based on volatility. Most of them just write covered calls on the IBIT. You also have BITY and Baggy now from Amplify ETFs. BITY targets 2% a month or 24% yield. They do out of the money calls, so you're going to capture more Bitcoin upside. Baggy, maximum income. It covers the whole portfolio. So if if you're more bullish on Bitcoin and you're very happy with 24% yield, you're going to go with Biddy. You think that you're more bullish on Bitcoin, but if you just want to maximize yield, you're going to go with Baggy. There's also Maxi as well, which I believe increased the distribution because of all this new competition of all these high yields. They've increased the distribution from 10 cents to 30 cents to 50 cents. I'm sure it's a response to all these high yielding competitors. But if we do a total return, guys, Maxi's still the king, I believe, after 1 year. Of course, a lot of these are new. We don't have that much data, but year to date, 1 year, Maxi's winning. Of course it is. If Bitcoin does really, really well, it's on a rocket ship. Maxi will probably always beat them because Maxi doesn't do covered calls on Bitcoin. So they're capturing the full exposure to Bitcoin, full price action to Bitcoin, and they're doing 1 million covered call and put spreads on various different things like the gold ETF and MicroStrategy and NDX, which is NASDAQ, and RUT, which is Russell 2000, SPX, which is S&P 500. So they're basically giving you Bitcoin exposure, but adding a little income doing those call spread strategy. It's kind of like their high ETF with Bitcoin, right? So that one's winning. But in terms of just the Bitcoin ones between YBTC and BTCI, you see YBTC year to date has a little advantage even in the 3 months, but we'll have to wait till time goes on. Of course, we don't have the data for Biddy and Baggy. So that's it, everyone, for the review, the monthly review here. In terms of sectors that are undervalued, it's very hard to tell because the markets are pretty much at all-time highs right now. Don't forget to check out this video. I think you'll find it very useful, and hit the like button too. I'd really appreciate it. Make sure to check out all the links and everything in the video description. I keep getting questions about how do I access this, how do I access that. All the information, everything you need to know is all in the video description. So make sure to check it out. And next month, we're going to do this again. We're going to do this all over again. So you stay updated on the high yield, income oriented landscape. Of course, it's very hard. I can't cover every single covered call income ETF now in the US because there's 1 million of them. But the number one piece suggestion I would give you is always make sure you're comparing the ETF. Don't just look at the yield, look at the total return. Always ask yourself, will this beat a regular classic S&P 500 or NASDAQ 100 covered call ETF? The answer is usually no, except for Bitcoin, of course, but that could change. But anyway, see you next month, everyone. Take care.